Max just paid $500,000 for a flat piece of asphalt with 40 painted lines on it. And it might be the laziest business in this entire series. No walls, no roof, no tenants, no toilets. Just dirt, paint, and a machine that takes money. Today, how to acquire a parking lot, the honest math on what those painted rectangles earn, and why the real prize isn't the parking at all. It's the ground underneath. First, why a parking lot even works as a business. Think about what every other property in this series comes with. Buildings that age, roofs that leak, tenants that call, machines that break. A surface parking lot has none of it. Nothing to maintain but paint, a little plowing, and a pay station. Nothing depreciates, because there is nothing to depreciate. One robot employee, the automated pay station, works 24 hours a day, takes cards, never calls in sick, and never steals from the till, the way the old cash box attendants famously did. It is the closest thing real estate has to a business with no moving parts. And that simplicity is exactly why sleepy family owners hold these lots for decades doing absolutely nothing to them. Which, as always on this channel, is where Max comes in, hunting for the family that has owned the corner since the 80s and still charges the same rates they did when gas was $2. Now, the lot Max bought. 40 spaces on a corner 2 blocks from a downtown hospital, owned for 30 years by a family that never once raised prices. The math: 40 spaces at a blended $150 a month, some monthly commuters, some daily parkers, comes to about $6,000 a month, $72,000 a year in gross revenue. Costs are hilariously small. Property taxes, insurance, plowing, striping, and the pay station fees eat about $22,000. Net operating income, $50,000. Small city lots like this trade around a 10% cap rate, meaning the income alone prices the lot at $500,000. Max paid exactly that. Here's how he pays for it. A local bank, because banks love simple collateral they can see from the street. Max puts 25% down, $125,000, and borrows $375,000 over 20 years at around 9%. Debt service, about $40,500 a year. So the honest day one math, $50,000 in, $40,500 to the bank, and Max clears $9,500 a year. Thin, very thin. And if that were the whole story, this would be a mediocre deal. It is not the whole story. Because parking has the strangest value-add playbook in real estate. First, event pricing. That hospital runs shift changes, and the arena 4 blocks away runs concerts. And on event nights, a flat $20 rate turns one evening into a week of normal revenue. Lots near stadiums make half their year on 60 event days. And the pay station reprices itself from an app while the competition's attendant is still swapping signs. Second, contracts. Max walks into the hospital's admin office and signs 20 guaranteed monthly spaces for their staff at a discount. Lower rate, 0 vacancy, revenue he can take to the bank literally. Third, squeeze the same dirt harder. A valet stacking operator can fit 30% more cars on busy days for a cut. EV chargers earn fees while cars sit, and the blank wall next door rents as a billboard for 4 figures a year. Run all of it and gross climbs from 72 to over 100,000, while costs barely move. And suddenly the lot is netting 75,000 and worth $750,000 at the same cap rate. But the landmines here are sneaky, because the business looks too simple to fail. 1. Supply you don't control. If the city or a developer opens a 1,000-space garage 2 blocks away, your rates fall the same week, so study the parking supply map like a hawk before buying. 2. Property taxes. Cities love reassessing downtown land, and a big reassessment can eat half your profit in one letter. 3. Cash leakage. If you buy a lot that still runs on cash and an attendant, assume a chunk of revenue has been walking away for years, and verify income through the payment processor, never the seller's notebook. And 4. The lease trap. Some parking operators don't own the land, they lease it. If the deal is a leasehold, you're buying a countdown timer, not real estate. Own the dirt or walk away. And check the zoning while you're at it, because the dirt is only a lottery ticket if something bigger is allowed to be built on it one day. And that brings us to the real secret of parking, the one the professionals whisper: the parking is just the dividend. The land is the prize. A surface lot downtown is a development site wearing a cheap costume. And Max gets paid $9,500 a year, soon 75, to stand on a corner that a developer may one day need badly. Parking lots downtown have a habit of becoming apartment towers. And when the knock on the door comes, the land often sells for double and triple what the parking income ever justified. Patient money loves a lot that pays its own taxes while it waits. Some of the best family fortunes in every American downtown started as exactly this. Somebody's grandfather bought a corner, striped it, and refused to sell for 40 years. So here's the parking lot playbook. Buy the dirt. Never the leasehold. Near something that never stops generating demand. A hospital, a courthouse, an arena. Price it honestly on today's income at a real cap rate. Automate the payments so no cash leaks. Then work the playbook. Event pricing, staff contracts, stacking, chargers, the billboard. Collect the thin cash flow, let the value adds fatten it, and hold the corner until the city grows to meet you. Boring dirt, painted lines, and one robot employee, quietly compounding into a fortune. This is Acquisition Insider, showing you how the machine really works. Subscribe.